2017 ended up being another very positive year for global equity markets. The JSE was up 21% and the MSCI World Index was up 23% in dollar terms. What is notable is this is the 9th year of the global equity bull market. As far as the JSE is concerned, the performance was flattered by Naspers, and importantly, we had some quite significant events during the course of the year. Firstly, we had significant noise around the political situation, which culminated in the ANC elective conference in December. We also had a very significant event in the implosion of Steinhoff, which caused tremendous jitters throughout the market and had significant implications for a number of investors. We think investors need to keep global equity valuations right at the front of their minds. Equity market valuations around the world are high, and if we look at somewhere like the US, they're at levels we last saw during .com or before that in 1929. So we're talking extreme levels. So we think investors today should be adopting a cautious mindset. And what we're seeing in practice is that most people seem to be doing exactly the opposite. If you look at all the measures using volatility and portfolio positioning, people are very aggressively positioned and hence are expecting strong returns from equities in the future. We think over these valuation levels, they're unlikely to deliver to those expectations. Off of these elevated valuation levels, we are finding fewer and fewer good opportunities within equity markets. A standout opportunity for us is within the local equity market, where many domestically facing companies remain very attractively priced. They trade on valuation levels that aren't too far off of bear market type levels, and significantly, their earnings levels are low. The economy in South Africa has been poor for a number of years, and we think that combination of low earnings with low price earnings ratios should give rise to good long-term returns. Importantly, many of those opportunities come from outside of the top 40, so they tend to be less liquid counters and typically mid or small cap shares. The PSG Flexible Fund is relatively cautiously positioned. We have in excess of 30% cash at the moment. 25% of that is domestic cash and 5% is offshore cash. This speaks to the limited opportunities we can find within the broader universe, but specifically we can find very good opportunity on the JSE. And this is in the more South African type companies that I referenced earlier, where we're very positive about the returns that can be achieved. So we're seeing a backdrop in which most market participants seem to be aggressively positioned and seem to be thinking it's appropriate to be dialing up risk. We're thinking the complete opposite. We're looking at this backdrop and we're thinking it's the time to be cautious and be focused on preserving your client's capital.